Doug Peebles, before we talk about tips for a rising rate environment, what I'd like to know is when rates are going to actually rise. You see the 10-year Treasury note stuck at 2.7% for a long time now.
Right, Greg. Look, I'm not too worried about rates rising very, very near term. I would say that we're probably looking at the next 3 or 4 years before we get a bigger increase in interest rates.
All right, let's talk about your tips then. The first one is to globalize your bond portfolio. What do you mean by that?
So at AllianceBernstein, we like to diversify economic cycle risk. And so, particularly in the United States, everybody's talking about when are U.S. rates going to rise? Nobody's really talking about when are European rates going to rise. So why not have a portfolio that can take advantage of investing in areas where maybe you're not having to predict to such a minute detail of when rates are going to rise in the United States?
Another tip you offer for rising rates, if and when it does happen, is adding high-yield corporate debt to your portfolio. Aren't spreads kind of tight now, though?
Yeah, I think spreads are tight relative to where they were post the financial crisis. But if we go back in history, longer than that, spreads are about the same average level that they've been over that time frame. Now, that's not terribly cheap, but we do think that you'll be able to clip your coupon in the high-yield marketplace and return, I don't know, maybe 6% or so, which is really a lot better than what most expectations are of what you're going to get in returns for U.S. Treasuries.
I'll take 6% right now.
Not too bad.
Your final tip is to spread your sector bets.
Right. So what that means is that most people, when they look to buy credit markets, they spend their time saying, I only want to own high yield, or I only want to own emerging markets, or only bank loans. Our view is that it's better to own multi-sector portfolios where the portfolio managers have an opportunity to spread out the bets across those sectors, take advantage of not only, as I mentioned before, economic cycle diversification, but also credit cycle diversification.
Doug Peebles, thanks a lot.
Thank you.
And thank you for watching The Street.